Well, hello, folks. Hello. My name is Benjamin Z. Miller. And in this video, I'm going to be talking about how exactly do you qualify for a multifamily loan? What is involved with that if you want to purchase a multifamily property? What exactly happens when you want to qualify for a multifamily property loan? Well, good question. First, please don't forget to like and subscribe. The answer is when you are aiming to secure financing for a multifamily property, grasping the essentials of the evaluation criteria is absolutely vital. In contrast to personal home loans, which are heavily dependent on the borrower's personal income, the approval for multifamily financing, that is for properties with 5 or more units in the United States, it hinges on the financial health and operational status of the property itself. So, for example, if you have a property that has 99, 95, 100% occupancy, that's much easier to get a loan for than one that is, of course, vacant. The other considerations are the owners or the sponsors of the entity seeking the loan. Of course, the bank's also going to look at that. This discussion basically talks about the specific criteria that are related to the property and also the sponsors. So if you want to be the sponsors, that banks are going to scrutinize during the loan approval process. So there's some metrics that are important. The occupancy rate. Basically, this metric, it signifies the proportion of rented units in a multifamily building. Financing institutions usually stipulate a minimum occupancy threshold of, say, 85 to 90% for properties considered to be stable. Certain financiers or banks, particularly those affiliated with government agencies, may also demand evidence of at least 90% occupancy over the preceding 3 months. The loan-to-value ratio represents the loan amount as a percentage of the property's market value or the selling price, and opting for the lesser of the two. Lenders often enforce a cap on the maximum allowable LTV ratio. The LTV is derived by dividing the loan sum by the property's value. The debt service coverage ratio. This is a measure of the property's net operating income against its yearly mortgage obligations, indicating a surplus cash flow post-mortgage payment. A preferable DSCR is higher. So the higher the debt service coverage ratio, the easier it is to get the loan, as it provides a buffer for the borrower against potential rental income volatility or occupancy fluctuations. To calculate this, you just are going to take the net operating income, you're going to add on the annual mortgage payments, and that is your debt service coverage ratio. The significance of the debt service coverage ratio lies in its ability to dictate the highest possible loan sum and influence the interest rates. Providing a detailed operating history for accurate NOI estimation is crucial for an accurate DSCR calculation. There also are metrics that are relevant to the sponsor, the liquidity. The liquidity of the sponsor is evaluated to confirm there are adequate resources to manage unexpected costs, vacancies, or financial responsibilities tied to the property. The net worth, the financial robustness of the sponsors through their net worth is assessed to gauge their capability in backing the loan. The experience in property management, the track record of sponsors in managing multifamily assets is considered as it reflects in their competency in ensuring the investment's success. The creditworthiness, the credit history of the sponsor is reviewed to determine their fiscal discipline and trustworthiness. For those that are seeking to finance a multifamily property investment, understanding and preparing for these property and sponsor related assessments is paramount. It is so important. But with thorough preparation and accurate representation of these metrics, applicants can enhance their prospects of obtaining favorable financing solutions for their multifamily ventures. If you would like to learn more about multifamily investing, just send me an email. Just email me, ben@benjaminzmiller.com. Once again, that's ben at benjaminzmiller.com. I hope that helps, and I wish you good luck with your investing.